Hi, so I'm Karen Kopecki, and I'm going to talk about what is not the honeymoon period, not planning for the honeymoon period of retirement, but planning for what's often the last talk, planning for what's often the last period of retirement when individuals need long-term care. And this paper is joint with Tony Brown, who's here, and this paper is Tony and my personal views. They do not reflect the views of the Federal Reserve System. Okay, so long-term care expense risk is big in the U.S. It's the second largest risk faced by Americans after earnings risk. 1 in 3 50-year-olds will spend over 100 days in a nursing home before they die, with an expected duration of 3 years and annual cost about $85,000. 1 in 10 will have out-of-pocket expenses above $200,000. Despite this, only about 10% of individuals 62 and over have private long-term care insurance, and take-up rates are low, even at higher levels of permanent earnings. In addition to take-up rates being low, the private long-term care insurance market has several other unique features. It's actually an endlessly fascinating market. So I will only touch on this, but denials are common. According to industry surveys, about 20% of applications are withdrawn or denied. Not everybody applies, and so one thing that we've done is we used underwriting criteria of Mutual of Omaha and Genworth and estimated that at least 36% of 55 to 66-year-olds in the health and retirement study would be denied this insurance if they applied, at least. Conditional on getting insurance, coverage is far from complete. Loads are high relative to other insurance lines. America is aging, and aggregate long-term care expenses are only going to increase. So that kind of begs the question, what can policymakers do? How can we reform the market? What are good public policies that can help Americans cope with the risk of incurring large long-term care expenses? And so what we've done in this piece is we use a structural model to kind of get a sense of what are potentially good policy reforms. And so I'm going to tell you very briefly about the model. The model has 3 frictions that have been shown to be really important for understanding low take-up in this market. The first is adverse selection. Basically, individuals have private information about their nursing home entry risk. There's a lot of evidence of this that's been documented empirically. The second is high administrative costs on insurers. I already mentioned loads are high for this product relative to other insurance products. Fees paid to brokers often exceed 100% of first-year premium revenue. This is one of the most difficult products to price. So underwriting costs are high. These are long-term contracts. Insurers often have to forecast 20 or 30 years forward, survival probabilities, nursing home costs, interest rates, lapse rates, and claims processing is more expensive. It's very easy to verify usually whether someone's alive or dead. It's much more difficult and costly to verify whether they really need long-term care expenses, long-term care, and the insurer really should be paying out to a nursing home, and then whether they continue to need them. So often then insurers are doing ongoing monitoring of people who are receiving these claims to ensure that they continue to need them. The third friction that's very important in this market is that there is an alternative insurer, and that's Medicaid. Medicaid is the main primary insurer of long-term care expenses, and it's means tested, so individuals who meet the means test can receive free Medicaid benefits to pay for care. Okay, so let me just briefly give you a sense of how the model works. Individuals in the model are going to differ in both their frailty and their permanent earnings, and they're going to face a risk of being old and needing formal long-term care. Their frailty and the permanent earnings are going to be predictive of that risk, but their true risk of needing care is going to be private information. And just like in reality, there's going to be 3 ways that they can insure. They can self-insure by saving, they can purchase private long-term care insurance at the start of retirement, or they can just choose to rely on Medicaid, the public insurer. Just as it works in practice, Medicaid's going to be means tested and paid last resort, and then there's going to be an insurer in a model, and he's going to sort people into risk groups based on what he can observe, their frailty and the permanent earnings, and then decide which risk groups to insure and pricing and coverage of insured groups. A lot of careful work has gone into disciplining this model with data and the model and assessing it with data. And the model actually does a very good job of matching a lot of different features of the data that I'm not going to have time to get into. Instead, I'm going to jump straight to giving you a sense of the importance of these three frictions for generating low take-up rates in the model. And so the model is able to generate not only the level of low take-up, but also the patterns across permanent earnings and frailty. So in the baseline model, the take-up rate is 9%. If we remove any one of these three frictions, Medicaid, administrative costs, private information, we get a big increase in take-up. So all three are important for understanding why take-up rates are low. Medicaid, maybe intuitively, is more important for understanding low take-up of lower income people. Private information and administrative costs are more important for understanding take-up of higher income people. All three of these frictions also have a big impact on coverage conditional on having insurance. They all contribute to incomplete coverage. And again, like with take-up rates, Medicaid's more important for understanding coverage of low-income individuals, and private information and administrative costs for higher-income individuals. Okay, let me jump to the policy experiments. So now we use the model and we ask what are good public policies for the U.S. long-term care insurance market, right? And so these are not necessarily, policies that, and we're not actually necessarily saying these are the policies that policymakers should employ, but we're using these policies to try to get an understanding from the model of what are the impacts of different directions we could go. And so one direction we could go is let's minimize the crowding out effects of the public insurer on the private market to allow the private market to be as large as possible given the other frictions that it struggles with. So that's going to be policy number one. Call that no Medicaid. The other direction we can go is let's just kill the private market and provide universal coverage of long-term care expenses, universal public coverage of long-term care expenses. Let the government pay for them. That's what we're calling universal Medicaid. The third policy reform we're going to think about is the long-term care partnership program asset exemption. And the way this works is that each dollar of coverage paid for by private long-term care insurance is going to exempt $1 from the asset test for Medicaid benefits. And so what this policy does is it basically loosens the Medicaid asset test for individuals who purchase private long-term care insurance. So it makes it both, so for every dollar of private long-term care insurance I purchase, I'm both more likely to qualify for Medicaid because the asset test has been loosened, and I can take more wealth with me into that state of the world where I'm now receiving nursing home care and it's being paid for by Medicaid. This policy is part of an initiative called the Partnership Program, Long-Term Care Partnership Program, which is a partnership between states and private insurers that was introduced in 2006 to promote long-term care insurance take-up. And so to assess these policies, we're going to look at their welfare effects, and we're going to measure welfare as a compensating variation. So this is going to be a % increase in consumption after the reform that makes the person indifferent between the pre- and the post-reform economy. So thing to remember is when you see these welfare numbers is, so if we have to give people more consumption after the reform, that means they're worse off with the reform. So positive numbers, when you see the numbers, positive numbers mean the reform's making them worse off because we have to pay them, compensate them for having imposed the reform. Negative numbers mean they're better off. Okay, so let's first talk about what happens when we remove Medicaid. So removing Medicaid leads to large welfare losses. We have to give the average individual 22% more lifetime consumption to make them as happy absent Medicaid as in the baseline. That's a huge welfare loss. And it's driven by welfare losses of low-income individuals. Take away Medicaid, these individuals have very inelastic demand for insurance. The private insurer takes advantage of that, raises the loads on their contracts, and enjoys higher profits. Now, more affluent individuals actually like this policy. The reason they like it, there's two reasons they like it. One, taxes go down, right? They're no longer paying for Medicaid. And two, we assume that the most affluent 1% of individuals in the economy, so actually that top 1, 2, and 3 is actually top 10, top 5, and top 1%. Sorry, my slides didn't get updated here. And so the top 1%, we assume that they own the private insurers, so they like the fact that profits have gone up. Yes. As in reality, I think. And okay, so let's think about the next reform. So now we go to the other extreme, and let's provide 100% public coverage of long-term care expenses. This kills the private market, and Medicaid outlays increase by 174% to 1.1% of GDP. On average, this reform is kind of a wash. It has a small, it's like the average individual slightly prefers this to the baseline. However, there's lots of disagreement. And so, the welfare gains come from gains, pretty significant welfare gains for the middle class, who, in the baseline model, middle class individuals are the ones that are most exposed to long-term care risk because they're relatively too wealthy to easily be able to get Medicaid, but they're too poor to easily self-insure. And so they really like this expansion of Medicaid. However, individuals both at the bottom of the permanent earnings distribution and at the top don't like this policy. Right at the bottom, they were already well insured by Medicaid in the baseline, so for them, this just means higher taxes. At the top, they can easily self-insure, and so they don't like the higher taxes, and the top 1% also don't like the loss of Medicaid of private long-term care profit income. Okay, so let me quickly talk about the third policy, which is the PP, the Partnership Program Asset Exemption. This is good for the private insurer. Take-up rates go up. Private long-term care insurance take-up rates go up from 9% to 62%, and loads and profits increase. However, coverage ratios do fall, and that's because people who now have private long-term care insurance are more insured by Medicaid, so in expectation they want less coverage by the private insurer. Now, one objective of partnership programs has been to reduce Medicaid outlays. We find public expenditures actually increase. Outlays per recipient decrease because of increased access to Medicaid. However, also because of increased access to Medicaid, the fraction of individuals who qualify for Medicaid benefits when they enter a nursing home go up, and that turns out to be the dominant effect on overall outlays. Despite outlays going up, the Partnership Program Asset Exemption turns out to have broad appeal and be the most attractive policy options of the one we consider. Those in the middle of the distribution benefit from the loosening of the Medicaid means test, and the top 1% like this because it also increases the size of the private market and profits of the private insurer go up. The only groups that really lose out are those in the permanent earnings quintile 1 and 2, but their welfare losses are very small. They're coming from slightly higher taxes. And so if you kind of look across the policies here, what this is telling us is that before I know my type, before I know who I'm going to be in this economy, what my permanent earnings and frailty are going to be, I prefer to be born into this world where this partnership program asset exemption exists. I prefer it over both the baseline, so where we are right now, and over having universal coverage, public government coverage of long-term care costs. So I'm just going to wrap up to say we find that this program is an attractive policy, produces a vibrant private long-term care insurance market while maintaining the safety net provided by Medicaid. The impact of these policies in practice so far has been small. Empirical estimates find that it increased take-up by at most 3 percentage points. So one of the things we're trying to do now is understand how we can reconcile the big impact it has in our model with what we've seen in reality. There's lots of things that are, partnership programs are complicated, and there's lots of restrictions there. Medicaid is complicated. There's lots of details about exactly how eligibility works. We don't have all of those features in our model, and so we're now trying to kind of untangle and see which ones are really having a big impact, potentially having a big impact on take-up in practice. But one kind of takeaway you can take from our findings is that it looks like potentially relaxing some of these restrictions that we currently don't model would make the partnership programs more effective. Thank you.